Micron just posted one of the best quarters in its history. Record earnings, record margins, 16 brand new long-term supply agreements signed, and the stock hit an all-time high. On the surface, this looks like a perfect story. But there is a detail buried inside this week's market data, and it changes how you should read this entire trade. The companies buying all that expensive AI memory, they are starting to bleed, and that matters more than any earnings beat. Let us start with what Micron actually reported. The numbers were genuinely impressive. Earnings came in well above analyst expectations. Gross margins expanded meaningfully, and 16 new long-term supply agreements were announced in a single quarter. That last number is the one investors celebrated most. Long-term agreements mean locked-in revenue. They signal that major tech buyers are committing to Micron's memory for years ahead. For a semiconductor company, that kind of visibility is rare, so the celebration made sense on the surface. The stock surged to a fresh, all-time high on Thursday. Hold that thought, because the other side of this story is just as important. High bandwidth memory, HBM, is the specific product at the center of Micron's boom. If you have never heard of it, here is a simple explanation. Modern AI systems need to process enormous amounts of data simultaneously. Standard memory chips cannot keep up with that demand. HBM stacks memory chips vertically, like floors in a building. That stacking dramatically increases speed and efficiency. NVIDIA's most powerful AI chips require HBM to function, which means every AI data center being built right now needs it. Demand has been enormous, pricing has remained strong, and Micron, alongside SK Hynix and Samsung, is one of the only companies that can actually produce it at scale. That supply concentration is exactly why the stock has run so hard. But here is the interesting part. The strength of the supplier does not automatically protect you from weakness in the buyer. This week gave us a clear signal about buyer stress. Apple announced price increases of $200 or more across its Mac and iPad product lines. That is not a product upgrade story. That is a company passing rising costs onto consumers because their own margins are being squeezed. Apple's stock is on track to fall more than 5.5% this week. That is a significant move for one of the world's largest companies. And Apple is not alone. The rest of the Magnificent Seven, the group of mega-cap tech companies that have led this entire market rally, came under pressure at the same time. This divergence is worth pausing on. Micron hit an all-time high. The companies buying from Micron sold off. That is not a contradiction. That is a stress signal forming at the seam between supplier and customer. If you are finding this useful, consider subscribing for more practical financial insights. The reason this matters for everyday investors is straightforward. HBM is expensive. It is significantly more expensive than standard memory. And the hyperscalers, companies like Amazon, Microsoft, Google, and Meta, are the primary buyers. They are building AI infrastructure at a pace that is genuinely historic. But building that infrastructure requires enormous capital spending, and capital spending at this scale eventually shows up in margins. When margins get squeezed, companies have a limited number of responses. They can raise prices on their own products, which is what Apple just did. They can slow capital spending, which would directly reduce demand for HBM, or they can absorb the cost and accept lower profitability temporarily. All three of those outcomes have different implications for Micron's future revenue. The 16 long-term supply agreements provide some protection, but long-term agreements are not unconditional contracts. Volume commitments can be renegotiated, pricing structures can shift, and if the buyers of HBM start protecting their own margins aggressively, the pricing power Micron currently enjoys could compress faster than the current enthusiasm suggests. Now here is what often gets overlooked in a moment like this. The consensus view right now is that HBM demand is effectively limitless. AI build-out is accelerating, data centers are multiplying, compute requirements are growing exponentially. All of that is true, but markets do not price reality, they price expectations of reality, and expectations for Micron are currently priced for near-perfect execution over multiple years. When a stock hits an all-time high on blowout earnings, the embedded assumption is that the next quarter will also be strong, and the quarter after that, and that pricing power will hold, and that buyers will not pull back. That is a lot of conditions that all need to remain true simultaneously. This does not mean Micron is a bad company. It is clearly not. The fundamental demand for AI memory is real and structural. Nothing about this week's data changes that long-term picture. But there is a meaningful difference between a great company and a great investment at any given price. and the emerging margin pressure at the hyperscaler level introduces a risk that the current stock price does not fully account for. Think about it from a practical angle. If you run a data center company and your margins are tightening, your purchasing team will eventually push back on memory pricing. That is basic business. The 16 long-term agreements Micron announced are genuinely positive, but they also revealed that the major buyers felt the need to lock in supply proactively, which tells us that supply is tight, and when supply is tight, price discipline from buyers tends to follow eventually. For everyday investors trying to make sense of this, here is the framework worth applying right now. Do not evaluate Micron in isolation. Look at the entire chain. The AI memory trade has multiple links: chip designers, memory manufacturers, hyperscalers, cloud platforms, and ultimately end consumers. When pressure builds at one link in that chain, it moves. Right now, the pressure is clearly building at the hyperscaler link. Apple's pricing announcement is visible evidence of that pressure. The Magnificent Seven weakness this week is further confirmation. None of this breaks the long-term AI investment thesis, but it does suggest that the next 6 to 12 months for HBM pricing may be choppier than the last 12. Strong earnings can coexist with that combination is often exactly where markets get caught off guard. The broader takeaway from this week is actually a useful one. Record earnings and a new all-time high in a stock are not automatically reasons to add more exposure. Sometimes they are reasons to revisit your assumptions. Micron's business is strong. The structural demand for AI memory is real, but the hyperscalers funding that demand are showing early signs of financial strain, and history suggests that supplier confidence and buyer margin pressure rarely coexist for long before one of them gives. Pay attention to which direction that resolution moves, because that direction will define the next major trade in semiconductor. That is what the numbers are actually showing right now. What you do with that information is entirely up to you.